When I talk about fixing emotional exit decisions, I'm not talking about some fancy trick or a shiny indicator you slap on a chart. I'm talking about the hardest part of trading, the part that lives inside your own skull. You can have the best entry in the world and still lose money if you don't know when and how to get out. That's where most men get ruined, and I learned that the hard way, watching good trades turn bad, because I let hope take the wheel instead of reason. Have you ever been in a fine profit and watched it slip away just because you didn't want to let go? You see, the market doesn't pay you for being right. It pays you for being disciplined. It pays you for sitting still when sitting is right, and for stepping aside when stepping aside is called for. Most traders think exits are about fear of losing. That's only half the story. The other half is fear of winning, fear of being done, fear that the move might keep going without you, and that little fear will whisper to you, just hold on a bit longer, until the tape turns and takes your money back. Haven't you felt that little whisper before? Back when I was learning this business, I noticed something simple but brutal. Every big loss I ever took was first a decent gain. I was in the right stock at the right time, reading the tape correctly. But when the stock told me the move was done, I refused to listen. I wanted more. I wanted to squeeze every last point out of it, and in trying to get the last eighth, I lost the whole dollar. Does that sound familiar? The tape never lies, but it does speak softly. It doesn't shout, "Sell now, you fool." It just slows down. It hesitates. The volume changes. The price stops acting the way it did when the trend was healthy. Those are the market's exit signals, but your emotions are loud, and they drown out that quiet message. So the first thing you have to fix in your exits is not your charting, but your ears. Are you really listening to what the market is telling you, or are you listening to what you hope it will say? A man who wants to build wealth in this game has to think like a business owner, not like a gambler. A business owner takes profits when they are there. He doesn't wait for a miracle. When a trade has done what it was supposed to do, you pay yourself. That money is your inventory. It is your ammunition for the next opportunity. If you let emotions keep you in too long, you're not being brave, you're being careless with your capital. And capital is the only thing that keeps you in this business. Without it, you're just another spectator, aren't you? One of the simplest ways to fix emotional exits is to decide your exit before you ever enter. When I buy a stock, I already know where I will get out if I'm wrong, and I have a fair idea where I will get out if I'm right. That plan is based on the chart, on the trend, on the behavior of the stock, not on how I feel 5 minutes later. Once I'm in, my job is to follow the plan, not to renegotiate with myself every time the price wiggles. Have you ever noticed how clever you suddenly become when a position is on the line? The market is a master at stirring up feelings. A fast rally makes you greedy. A small dip makes you scared. Both of those are bad advisors. What you want is to be cool and a little boring. When a stock has run its course, it will stop making new highs easily. It will start to struggle. That is when a professional takes his profits quietly and without drama. The amateur waits for one more push, one more burst, and that is usually when the stock rolls over. Which one do you want to be? Fixing emotional exits also means accepting that you will never sell at the exact top. Anyone who tells you they do is either lying or fooling themselves. The goal is not perfection. The goal is consistency. If you can sell somewhere near the top of a good move, over and over again, that is more than enough to build real wealth. You don't need the last tick. You need a steady stream of solid, well-earned profits. Can you live with leaving a little money on the table if it means keeping most of it? There's another trick the market plays on you. It makes you feel smart when you hold a winner. You start to identify with the trade. You say, "This is my stock." That's dangerous talk. You don't own anything out there except the cash in your account. A position is just a temporary agreement between you and the market. When the market changes its mind, you'd better be ready to change yours, too. Holding on out of pride is a sure way to give back what you made. I've always said that the big money is made by sitting, but knowing when to stop sitting is just as important. A trend pays you while it lasts, but when it ends fast. Your job is not to predict the end, but to recognize it. When the stock stops acting right, you don't argue with it. You step aside. That simple habit, repeated over years, is what separates a wealthy trader from a broken one. Isn't that what you're really after? Your money mindset shows up most clearly at the exit. When you're afraid to take profits because you want more, you're telling yourself that this is your only chance. A professional knows there will always be another trade. The market is full of opportunities. You don't have to marry any single one. Take what it gives you and move on. That calm confidence is built by experience and by respecting your own rules. Every time you exit a trade the right way, you strengthen that mindset. You teach yourself that you can follow a plan and be rewarded for it. Every time you exit the wrong way, by holding too long or bailing too early out of panic, you weaken that trust. Over time, that adds up. Your account balance is just a reflection of how well you handle those moments of decision. So when the chart is talking and your heart is racing, which one do you choose to believe? I used to think that being a great trader meant being fearless. I was wrong. It means being steady. It means being able to take a profit without regret and take a loss without shame. Emotional exits come from wanting the market to do something for you. Proper exits come from accepting what it is doing right now. That's a small shift, but it makes all the difference. So the next time you're in a good trade and it starts to slow down, don't ask yourself how much more you can make. Ask yourself if the reason you bought it in the first place is still there. If it isn't, you already know what you should do, don't you? Hope is not an exit strategy, and that idea sounds simple, but it cuts right to the bone of why most traders struggle to hold on to what they earn. Hope sneaks into a trade the moment you stop listening to the chart and start listening to your wishes. A stock starts to drift against you, not violently, not in a way that makes headlines, but just enough to make you uncomfortable, and instead of asking what the market is saying, you start telling yourself stories. You say it will come back. You say it always does. You say the news will turn it around, and all the while the tape is quietly showing you that the move you bet on is losing its strength. Have you ever noticed how hope sounds calm and reasonable right before it empties your account? The market does not care about what you hope. It cares about supply and demand, about who is willing to pay up and who is eager to sell. When buyers are strong, price moves easily in your favor, and when that strength fades, the price begins to sag and hesitate. That hesitation is the market's way of telling you that the reason you entered the trade is no longer as powerful as it was. But hope is a stubborn thing. It makes you ignore small warning signs because you want the big picture to stay the way it was. You remember how good the trade felt when it was working, and you try to trade that memory instead of the reality in front of you. Isn't it strange how we trust our memories more than the living, breathing chart? A disciplined exit is built on observation, not imagination. You watch how the stock behaves near key levels. You see whether it makes new highs easily or struggles to get there. You look at volume, at how enthusiastic the buyers really are. When those clues turn against you, the smart thing to do is to step aside. But hope tells you to wait. It tells you that you will look foolish if you sell and the stock goes right back up. That fear of looking foolish is one of the strongest forces in trading, and it keeps people tied to losing positions far longer than they should be. Have you ever held a trade just to prove you were right? The trouble with hope is that it replaces a plan. When you entered the trade, you had a reason. Maybe it was a breakout, a trend, a strong earnings report, or a clean pattern on the chart. That reason was your edge. Your exit should be based on whether that edge is still there. When you ignore that and start hoping, you are no longer trading your method, you are trading your emotions. That is when exits become sloppy and dangerous. You don't leave because the trade is no longer valid. You leave because you are tired, scared, or finally too frustrated to keep pretending. By then, the market has already taken more from you than it needed to. Hope also shows up when you are in a winning trade. A stock runs up nicely, and you see your account grow. Instead of asking whether the move is still healthy, you start dreaming about how much more it might make you. You picture the bigger house, the extra security, the feeling of being right. Those dreams are pleasant, but they have nothing to do with the tape. When the stock begins to stall, hope tells you that it is just resting before the next big push. Sometimes that is true, but sometimes it is the start of a reversal. The chart will usually give you hints, but you have to be willing to see them. Do you look at those hints, or do you look away because you want the dream to continue? A trader who relies on hope is always late. Late to take profits, late to cut losses, late to admit that the story has changed. The market rewards those who act when the information changes, not those who cling to yesterday's picture. This is not about being pessimistic. It is about being realistic. You can be optimistic about your long-term success while being ruthless about individual trades. In fact, that is the only way to survive long enough to build real wealth. Every time you close a trade based on what the market is actually doing, you reinforce that realism. Every time you stay in because you hope, you weaken it. There is a quiet confidence that comes from knowing you do not need to squeeze every last cent out of a move. You take your share when it is offered, and you walk away. Hope tries to convince you that this is the only opportunity that matters. Experience teaches you that opportunities are endless. When you understand that, you stop begging a single trade to save you, and you start treating it as just one of many. That shift alone can clean up your exits more than any indicator ever could. Have you ever noticed how much easier it is to sell when you know another setup will come? Hope also blurs your risk. You may have decided before you entered that you would only risk a certain amount, but when the trade moves against you, hope whispers that it is just a temporary dip. You move your stop, or you ignore it, and suddenly a small, manageable loss turns into something painful. That pain makes you hope even harder, because now you want the trade to come back, just so you can escape without damage. It is a trap that has caught more traders than any bad chart ever did. The only way out is to respect your original exit and accept the small loss. When you trade without hope, you trade with clarity. You see the price for what it is, not what you wish it were. You see the trend as it is forming or breaking, not as it was yesterday. That clarity allows you to act calmly, even when money is on the line. It does not make you emotionless, but it keeps your emotions from making the decisions. Over time, that habit builds a kind of quiet strength, a feeling that you are in control of your process even when the market is wild, and that feeling is worth more than any single trade. The chart speaks before emotions shout, and that is one of the great truths of trading that most people learn only after paying a heavy price for ignoring it. Long before you feel fear in your stomach or excitement in your chest, the price has already begun to change its tone. The bars on the chart start to behave differently. The rhythm shifts. The smooth movement of a healthy trend gives way to hesitation, to choppy action, to uneven pushes. Those are the first words the market speaks, but they are quiet, and you have to be paying attention to hear them. Have you ever noticed how your feelings always seem to arrive a little too late? When a stock is moving the right way, it does not argue with you. It climbs or falls with purpose. It pulls back gently and then resumes its path. That kind of action builds confidence, but it also plants the seed of attachment. You begin to like the trade. You begin to feel comfortable. That comfort is dangerous because it makes you less alert to subtle changes. The chart, however, never gets comfortable. It records every shift in buying and selling pressure without bias. When that pressure starts to weaken, the chart shows it immediately, but your emotions are still living in the past, enjoying the profits you already have. Isn't it strange how we feel safest right before things begin to change? A good trader learns to read those early signs. Maybe the stock makes a new high, but it does so on lighter volume. Maybe it breaks above a resistance level but cannot hold there. Maybe the pullbacks start to get deeper. None of these things guarantee a reversal, but together they form a message. The chart is saying that the balance between buyers and sellers is shifting. That message comes before any headline, before any panic, before any rush for the exits. If you are listening, You can act calmly and deliberately. If you are not, you will act in a hurry later, when the emotions finally catch up. Which way do you usually experience it? Emotions are always reactive. They respond to what has already happened. By the time you feel fear, the price has already moved against you. By the time you feel euphoria, the move has already matured. That is why relying on feelings for exits is so costly. You are always behind the market. The chart, on the other hand, is real time. It shows you what is happening now. When you train yourself to trust what you see instead of what you feel, you step out of that losing game of reaction and into a quieter, more professional way of trading. There is a kind of honesty in a chart that you will not find in your own thoughts. Your mind wants to protect you from discomfort. It wants to avoid regret. It wants to keep the good times going and push away the bad. The chart has no such agenda. It simply marks where trades are being made and at what price. When demand dries up, it shows you. When supply overwhelms buyers, it shows you. That information is there for anyone who is willing to look. The trick is to look even when you do not like what you see. Can you do that when money is on the line? Many traders talk about being patient, but patience without awareness is just blind waiting. True patience is staying with a trade as long as the chart supports it, not as long as your feelings want it to last. When the chart begins to speak a different language, patience means being willing to step aside. That is not weakness. It is respect for the reality of the market. The sooner you accept that, the more control you gain over your exits. The chart also protects you from the stories that swirl around every stock. News, rumors, and opinions can all make you feel something, but none of them change the fact that price is either moving in your favor or it is not. When the chart shows distribution, when rallies fail and selling pressure increases, that is a louder truth than any optimistic article. If you wait for your emotions to line up with that truth, you will usually wait too long. Have you ever watched a stock slide while you kept telling yourself that the news was still good? There is a discipline in checking in with the chart regularly during a trade. You ask simple questions. Is the trend still intact? Is the stock still making progress? Are buyers still in control? These questions keep you grounded. They keep you focused on evidence instead of hope. Over time, that habit rewires how you experience trading. You start to feel less anxious because you are not guessing. You are observing, and observation is far steadier than emotion. When you ignore the chart and follow your feelings, exits become dramatic. You sell in a rush, or you cling in desperation. When you follow the chart, exits become almost dull. You see the warning signs, and you act. There is no need for a big emotional moment because the decision has already been made by the evidence in front of you. That dullness is a gift. It means you are doing your job without letting your heart get tangled up in it. Over many trades, this way of operating builds trust in yourself. You know that you will not freeze when a move starts to fade. You know that you will not get greedy when it starts to surge. You have a framework that is outside of your moods. That trust is what allows you to scale up, to handle more size, to think in terms of building wealth instead of just surviving the next trade. Without it, every exit feels like a gamble, and gambling is not a business. The market will always test you. It will tease you with a little more upside after you sell. It will scare you with a quick drop after you buy. Those tests are designed to pull you back into emotional decision-making. The chart helps you pass those tests because it keeps you anchored in what is actually happening. When you see a stock fail to follow through, you do not need to argue with it. When you see strength return, you can always get back in. That flexibility is only possible when you are not married to your feelings. So each time you look at a chart, remember that it is speaking to you long before your emotions find their voice. The more you learn to hear that quiet language of price and volume, the less power fear and greed will have over your exits. A stalled trend is an unspoken sell signal, and most traders miss it because they are waiting for something louder, something more dramatic, something that feels like permission to act. The market rarely gives you that kind of courtesy. When a trend is healthy, it moves with a certain ease. Prices push forward, pull back a little, then push again. The rhythm is smooth, almost confident. But when that rhythm starts to falter, when forward progress becomes labored and uneven, that is the first quiet warning that the move may be running out of steam. Have you ever felt that uneasy pause on the chart but chosen to ignore it? A stall does not always mean a crash is coming. Often it simply means the balance between buyers and sellers is changing. The people who wanted to buy have already done so, and now the stock needs new demand to keep moving. When that new demand does not show up, price begins to drift sideways or make small, weak pushes that go nowhere. That sideways action is not boring, it is information. It tells you that the easy money in that move has likely been made. Yet hope and greed make those quiet bars look harmless, even friendly, as if the stock is just resting before another big run. What really happens during a stall is that smart money is often distributing its shares to latercomers. While the price holds near the top, volume may increase, and the stock cannot push much higher. That is a sign that supply is meeting demand. Those who bought earlier are happy to sell at these high levels, and those who arrive late are happy to buy, thinking the trend will continue forever. The chart shows this tug of war long before the price breaks down. Are you watching that struggle, or are you only watching your open profit? A trader who understands stalls does not need to predict the top. He simply respects the loss of momentum. When a stock that once moved easily now struggles to make progress, that is enough to make him cautious. He may take partial profits. He may tighten his stop. He may step aside altogether. The point is not to be perfect. The point is to stop acting as if nothing has changed when something clearly has. That small adjustment can save a large amount of money over time. The danger of a stalled trend is that it feels safe. The stock is not collapsing. It is just sitting there. That quiet can lull you into a false sense of security. You think you have time. You think you can wait for one more push. Meanwhile, the market is quietly absorbing supply, setting the stage for a move in the opposite direction. When that move finally comes, it often comes fast, and by then your emotional exit kicks in, forcing you to sell lower than you ever planned. Have you ever been caught by that sudden drop after a long, sleepy top? A stall also tests your discipline. It is easy to sell when a stock is plunging. It is harder to sell when it is just going nowhere. That is when your mind starts to bargain. You say you will give it one more day, one more bar, one more try. That bargaining is emotional. It has nothing to do with the original reason you bought the stock. If you entered because of strong momentum, and that momentum is gone, then the trade has already told you what to do. The fact that it has not yet turned into a loss does not change that message. In many ways, a stall is the market's polite way of telling you that the party is winding down. The music is still playing, but people are starting to look at their watches. Some are already heading for the door. If you wait until the lights come on and the music stops, you will be fighting the crowd to get out. The chart gives you a chance to leave while it is still easy. That is what makes a stall such a valuable signal if you are willing to take it seriously. Learning to recognize stalls also improves your mindset. It shifts you from being reactive to being proactive. Instead of waiting for pain to force you out, you choose to leave when the edge is no longer there. That choice builds confidence. It teaches you that you do not need to be trapped in a trade. You can always step aside and look for the next opportunity. Over time, that freedom changes how you relate to money and risk. A stalled trend can show up in many ways. It might be a series of small candles after a big run. It might be repeated failures to break a recent high. It might be a flattening of a moving average that had been rising strongly. The specific pattern matters less than the overall message: progress has slowed. When progress slows in a market that lives on momentum, you should pay attention. Are you really prepared to ignore that and hope for the best? The longer a stall lasts, the more dangerous it becomes. Each day that passes without a new high is another day for sellers to quietly unload. By the time the breakdown happens, much of the selling has already been done at higher prices. That is why the drop can feel so sudden and unfair. In reality, it was being prepared right in front of you, while the price drifted sideways. The chart was telling the story the whole time, but it was telling it in a whisper instead of a shout. Good exits are often boring. You sell not because of a dramatic signal, but because the trade no longer feels alive. That feeling, when it is backed by what you see on the chart, is not intuition in the mystical sense. It is pattern recognition. It is your mind picking up on the subtle signs of a stall. The more you respect those signs, the more you protect your capital. Every trader who has stayed in the game long enough has a memory of watching a great winner turn into a mediocre one, and then into a loser, all because he refused to act during a stall. Those experiences are painful, but they are also powerful teachers. They show you that the market does not need to crash to tell you to get out. Sometimes it just needs to stop going your way. Discipline at the exit protects capital, and capital is the lifeblood of every trader, whether he admits it or not. You can have the sharpest eye for entries and the best instincts in the world, but if you let your exits be ruled by impulse, all that skill will slowly leak out of your account. The market is patient, and it waits for you to make mistakes. Most of those mistakes happen not when you get in, but when you decide to get out. Have you ever noticed how easy it is to click the buy button, but how heavy your hand feels when it is time to sell? An exit is a moment of truth. It is where plans meet pressure. While a trade is open, it is still a story with many possible endings. When you close it, you make that story real. That finality is what makes exits emotional. You are not just locking in a profit or a loss, you are also locking in a judgment about yourself. Discipline is what keeps the judgment from turning into a personal drama. You are not saying you are smart or foolish. You are simply following a set of rules designed to protect your money. Capital gives you choices. With capital, you can wait for the right setup. You can size your trades properly. You can survive a streak of bad luck. Without capital, none of that matters. That is why disciplined exits are so important. They keep small problems from becoming big ones. They keep a single trade from having the power to define your entire account. Over time, that steady protection is what allows you to grow, not in a flashy way, but in a durable one. When you lack discipline at the exit, you are essentially handing control to your emotions. Fear will push you out of good trades too early. Greed will keep you in bad trades too long. Both of those errors chip away at your capital. They do it quietly at first, a few points here, a few points there, but the damage adds up. One day you look at your account and wonder where the money went, and the answer is usually hiding in a long list of poorly managed exits. Do you ever go back and really study how you got out of your trades? A disciplined exit begins with a clear plan. Before you enter a trade, you decide where it no longer makes sense. That level might be based on a chart pattern, a support level, or a percentage of risk you are willing to take. Whatever the method, it must be defined ahead of time when you are calm and objective. Once you are in the trade, that plan is your anchor. It keeps you from drifting with every emotional wave. Without it, you are just guessing, and guessing is not a business model. There is also discipline in taking profits. Many traders think discipline only applies to cutting losses, but it is just as important on the winning side. When a stock reaches your target or starts to show signs of slowing down, discipline tells you to take what the market is offering. It is tempting to hold on for more, to see if you can squeeze a little extra out of the move, but that temptation is the enemy of consistency. A disciplined trader would rather take a solid, repeatable gain than gamble for a slightly bigger one. Protecting capital does not mean avoiding risk. It means choosing risk carefully and controlling it relentlessly. You accept that losses are part of the game, but you refuse to let them get out of hand. You also accept that gains will never be perfect, but you make sure they are real. That balanced attitude is what keeps your account healthy. It is not about being aggressive or timid. It is about being steady. The market will often try to lure you away from your discipline. It might dip just below your stop and then rebound. It might surge a little after you sell. Those moments can make you question yourself. They can make you think that maybe you should be more flexible, more intuitive. But over a large number of trades, discipline wins. The times when the market teases you are far fewer than the times when it punishes you for hesitation. Have you ever kept a trade open just because you did not want to be wrong? One of the hardest lessons in trading is that being wrong is not a failure. It is simply feedback. When you exit a trade according to your plan and it turns out that the market later goes your way, that does not mean you made a mistake. It means you managed your risk. Over time, that approach keeps you in the game long enough for your edge to show itself. Without it, even a good strategy will eventually be undone by a few undisciplined moments. Discipline at the exit also affects your mindset outside of any single trade. When you know you will protect your capital, you trade with more clarity. You are not afraid of every tick against you, because you know where you stand. You are not obsessed with every tick in your favor, because you know you have a plan for taking profits. That mental space allows you to see the market more clearly. It turns trading from an emotional roller coaster into a measured process. Wealth in trading is built slowly through many small, well-managed decisions. Big wins make headlines, but steady risk control builds accounts.